You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. On This Week on the Biz, our Indexed Universal Life product expose featuring Athena Indexed Universal Life Insurance with Matt Berman, Vice President, Sales and National Accounts with AXA Distributors.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 3 in our saga of Indexed Universal Life Expose, although we kind of dipped a little bit into VUL yesterday, Matt Berman.
Good to be here.
Matt, I had to dip into VUL because you threw in the index sleeve onto the product chassis, which I think is extremely unique. I don't know of any other carrier that does it like that. And if you say, Steve, I don't even know what you're talking about, go back out to our show, www.brokersalliance.com. As soon as you come to our homepage, you'll see a huge red button on our archive on-demand video. Click it and look at yesterday's show and see what I'm talking about. If you're in the VUL space and you're looking for another distinctive as a practitioner, this could be a product. But we're not talking about VUL, sorry about that. We're talking about indexing. And when I'm looking at indexing, I'm always looking at a few things.
Yep.
Caps.
Yep.
Participation rates, and what indexes are you playing in? So let's just talk a little bit about each one, their caps, par rates. Why did you go down this road? Because everybody has their specific tinkering, you know, they have their reasonings and their own actuarial math that they come to come to these conclusions. You chose these for certain reasons. I mean, there's a huge space out there of indices, and you chose these 4. Why?
Well, great question. We wanted to keep the product chassis simple, but we also wanted to give breadth and scope, so there is optionality for the policy owner. And we chose 3 specific indices, and then we'll go into the 4th, which is really a time-based differential. So S&P 500 to get classic equity participation with the marketplace. We have the Morgan Stanley Capital IFA account, which is giving you international exposure. And then we have the Russell 2000 Index, which is giving you more small cap exposure if you feel that there's good pickup in that specific market. You mentioned the 4th, and that 4th is our S&P 500, but the difference is it's a 3-year segment duration as opposed to the traditional 1-year duration. And that is, I think, a great option for younger individuals that have more risk tolerance and maybe a longer time horizon on accumulation or their death benefit coverage. So
I might make sure I got you right. So I have my traditional S&P 500 annual point-to-point.
Correct.
But on this one, you have the S&P 500 36-month point-to-point. Is that
exactly,
hear that right?
That's exactly right.
Now, why did you choose 3 years? I've noticed a couple carriers that do this, what I would call this greater, longer, elongated duration. They're hitting 5 years. I've seen a lot of them doing 5 years, 60 months. Why did you guys choose 36? Why was that time slot working for you?
We felt 3 years was an appropriate time horizon for individuals to play long-term, but have a reasonable length to actually realize growth. So it was a product of product manufacturing, our hedging, and just what we felt was out there in terms of prospective demand. And so far, it's gotten some great interest. We're seeing sales coming more towards that younger demographic, having that 3-year point-to-point index.
Well, let me ask you that, because I think that's a very interesting play, because a lot of our older agents that are my age, baby boomer representatives, advisors, are always saying, Steve, what's going on with Gen X, Gen Y, and the millennials? What are they doing? When you tell me sometimes there's a movement now towards the younger generations going to a 3-year point-to-point, I'm going to go, well, now what are they seeing that we don't see? Or is it a time issue? Or is it more of a propensity for risk? What do they? Why do they have that?
Yeah, I think it's a little bit of both. But when I think about it, I think that there is more tolerance for risk. And I think judging by historical performance in the marketplace, long-term equities do perform. We've seen some bumps in the road for the past few years, but a willingness to ride out those bumps and to capture long-term performance, I think, is nicely aligned with having a 3-year differentiator in the chassis.
Yeah, well, actually, that was the first thing I thought about. Was I like to offer my clients some options. And everybody, most of the market, I would say the vast majority of the market is in annual point-to-point. Now, when we start looking at 36-month point-to-point, that's a differentiation.
Sure.
And I want to be able to go to my client and say, here's another distinctive avenue that you can pursue.
Sure.
And I like that option. Talk a little about, but I'm really more interested, I hate to say this because S&P is kind of like the vanguard. We all pretty much appreciate that.
Sure.
Russell 2000, I think everybody knows that's our second position, very big in the small cap area. But I'm sorry, I'm not really attuned to the Morgan Stanley push here. Talk a little bit about that because I think they would be interested in that.
Yeah, I think that the Morgan Stanley Index is allowing an individual to see pickup on international exposure. So simply
now,
put,
when you mean international, everywhere? I mean Europe, Asia,
so,
developing companies, or I mean emerging countries. What?
So it's Europe, Australasia, and Far East.
Oh.
So we're looking at a strong breadth of companies that are overseas, and let's face it, we are in a global economy, and we do have great resources and great opportunities elsewhere outside the U.S. So this is a very, very simple way to get equity performance and participate on prospective gains outside the U.S.
Have you seen a trend towards that? I'm just curious, just from a strictly sales point of view. Have you seen people electing that kind of edge, kind of a different idea to go down?
We are.
S&P?
We are, but I'll be honest, I think that this is still a young market. And when I say market, I'm talking Indexed Universal Life. So a lot of the participation and election is driven towards traditional S&P 500. We are seeing some interest, but I would imagine that interest will grow over time as people are more comfortable with the product and we start seeing historical returns on these indices.
Well, when I think about international growth, when I think about the kind of emerging markets that are happening today, I just want to have access to them in case they take off. I don't know who's going to win. And I like the options to be able to move from one to another. Is our global economy getting smaller? Is it shrinking? Is everything correlated now? Well, you be the judge on that and let your client make that call. When we come back from the break, we're going to address more of the Athena Indexed Universal Life product, its application in your practice. Hey, and don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Auction House. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm practicing my auctioneer skills for our carrier bidding process for our producers' substandard cases.
Steve means that we're packaging our substandard cases for underwriters with specific carriers that are known to specialize in certain health impairments.
There are really only a handful of competitive carriers in each category, and we've identified who they are.
It's all about securing the best possible underwriting offer by packaging your substandard case with the right carriers.
So let the bidding begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Matt Berman. And remember, you can order today's giveaways at thebiz@brokersalliance.com. And what are we giving away? I'm giving away my patented document. It's a great attachment. Dollar cost averaging. A lot of our clients don't really have annual premiums. You want to do monthly cash flow kind of investing and savings? Dollar cost averaging is a great idea and it's a great piece. The next thing we're giving away is AXA's product suitability. It's a really nice piece by AXA. It's wonderful. And their other piece, uncovering and evaluating needs, which I like to walk through, especially if you're coming new to our market and you're not used to a sales track or you're not used to asking the right questions. This helps you ask the right questions, and until you get comfortable with it, I suggest that should be your sales track. And remember, just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor and broker-dealer compliance officer before going forward. In this segment, we're continuing our saga on the Athena Indexed Universal Life product and its application in your practice. We're talking about distinctives. I always like that. You know me, I'm Mr. Marketeering. What do you have that's different? And I like that. We're talking about Morgan Stanley. We're talking about the S&P, but the 3-year point-to-point, the 36-month point-to-point. And now we're going to talk a little bit about the caps and pars with each of these to kind of give you an idea and break this out. And if you say, Steve, I need the specs, the full specs on the Athena product. I have it for me. I'll throw it in. It's not part of my thing, but I'll throw it in today. If you write me at thebiz@brokersalliance.com, I'll send you the complete policy summary specs of the Athena product.
Great, great. So thanks for introducing the product. I think that we've got some unique options in the product that allow you to determine your own destiny on coverage and performance. So you had mentioned that we have 3 indices and 3 sleeves within the product, and we have a 4th, which is really a time-based differential against the S&P 500 at 3 years. The one thing I do want to mention is each of these indices are based on 100% participation, and we also offer an option which we call our choice option. So if you are truly bullish on the market, what we allow you as the policyholder to elect is for 100 basis point asset charge against money in the segment. You can elevate your cap by 3 points today on current rates. That will be determined, from month to month, of course, based upon interest rates and volatility. But today, you get 3 additional points pickup on the indice for the S&P 500. For the other 2, IFA as well as Russell 2000, they vary, not quite as high as 3%. But again, we wanted to allow some flexibility and some optionality for you as a policyholder to control your own destiny with the account.
I'm wondering if we looked at the S&P and we did backcasting, I'm wondering if that 100 basis point would be a great deal to spend down to pick up that extra pop. Because my thinking is, usually can carriers do these kind of elaborate issues and there's a charge to it, there's also a good positive to it too.
Sure.
So I'd like to see what the yin and yang, I'll have to do some backcasting on that, I'll let you know. If people say, Steve, did you do it? When I go back and I look at history, I'm going to look at what the numbers are. Talk a little bit more about, now we talk about the cap, so like right now on the S&P, the 2 S&Ps, what are the caps on those 2 products?
So with the 1-year S&P on the basic option, 10%. On the 3-year option, it's 45%.
Whoa.
Oh, sorry, it's 40%.
Oh,
sorry, 40%.
Well, 40% is still big.
Yeah.
So let's back up. What's the participation?
100%.
So if I sit in 3 years and I have a 40% top out, because here's where I think these guys are, remember, as most of you know, I watch this stuff like a hawk.
Sure.
And I'm always looking at all our grids and spreadsheets to determine who the players in this are. To me, this is another unique issue that AXA has. And I love having 40%, 100% part, can I wait 36 months? Can I hold on? And my mind says, especially if you're younger, why would you not go to this play?
Sure.
Now, can I actually buy an additional number on that or not really?
You can. So on the 3-year sleeve, going to the choice option actually gives you unlimited upside. So that's a unique differentiator for what we've seen in the marketplace today. But again, for someone that has the time horizon, someone that has a risk appetite that is aligned to the hiccups that you may have in any given period in the marketplace, it's a great option to have a floor at 0% and unlimited upside.
Well, I'm going to have to, again, check my grids, but I don't know if anybody's giving that kind of number on a longer, I've seen 2, 3, and 5-year platforms. We're talking about a 36-month point-to-point in this one.
Sure.
To have that kind of headroom, to me, is huge for a client, especially if they are, as you said, qualifying bullish, they have good risk tolerance, they understand that, and they don't need to have direct recognition every year on their accounts.
Sure.
It's a long-haul thinking mentality. The investment is long-haul in their posture. I think that's another area you need to go to, what? Differentiate your practice with a differentiating product.
Great.
Well, to give us a little summary, because we don't have too much time left here, but when I'm looking at this, what are the other caps now? Morgan Stanley's at what, 10?
Morgan Stanley's at,
9.
Yeah, Morgan Stanley right now is at 9, and the Russell 2000 is at 8. Now, the one thing I do want to state for the show is some of you out there may be thinking, okay, if I'm looking at a standard point-to-point S&P 500 1-year duration segment, 10% cap, that seems somewhat low in the marketplace. And you know what, as a company, we recognize that the competitive landscape may drive towards higher caps. But it's consistent with the story that we've been promoting in the marketplace, which is to try to drive the strongest net cost coverage and make that coverage as competitively priced as possible. At the end of the day, the caps are manufactured by a hedging strategy, and there's a cost attributable to that hedging strategy. We didn't want to pass an exorbitant amount of fee into the product. We didn't want to bake it with too much subsidization, so we wanted to keep it as sustainable as possible in the longer term. And we really feel that the caps that we've set, while they may not be top of the market, they really drive effective performance and really, really cost-effective coverage.
And remember, you can watch this show and all our shows by clicking the red on-demand button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.